Bitcoin, Ethereum, XRP, and Solana, or as I like to call them, Fantastic Four of crypto. By the end of this video, you will go from knowing absolutely nothing about crypto to understanding everything about top 4 cryptocurrencies out there. This information is known by less than 1% of entire world population. So if you are tired of missing out easy opportunities, make sure to stick around until the end. I am Bitcoin Professor, and I want to welcome you to Bitcoin Academy, #1 growing platform for crypto education. Information we are sharing is paid thousands of dollars through courses. So the least you can do is subscribe to our channel. Today, we will speak about 4 crypto giants, explaining each one separately. So if you already know about Bitcoin, for example, you can use timestamps to navigate to any other topic you don't know. Understanding these 4 is close to understanding everything in world of crypto, because basically everyone else is trying to compete with them. So without further chit-chat, let's start with father of crypto, which is none other than Bitcoin. And we will do that by going through 4 key topics. Topic number 1, traditional money problems. Perhaps the simplest way to think about Bitcoin is to begin with real-life example. Let's say I owe you $100. How am I going to pay you? The simplest way for me to do that would be to give you a $100 bill in cash. That seems straightforward enough, right? You get your money immediately, and the debt is settled. You can then do whatever you need to with it. Buy something, save it, give it to someone else. There are a few key things that make this transaction effective. It's instant. The moment I hand over the cash, the transaction is complete. No waiting, no delays, no third party is involved. It's just you and me. There's no bank, no service provider, no one approving or processing the transaction. It's private. Nobody else needs to know this transaction took place. It's just between us. This type of transaction is called peer-to-peer. It's direct and simple, but there's one big problem. We have to be in the same place for it to work. If we're not physically in the same location, paying you in cash becomes a challenge. Sure, I could put the cash in the mail and send it to you, but then we'd have to trust the postal service to deliver it. That introduces delays, additional costs, and the risk that the money could get lost or stolen along the way. If you live in a different country, the problem becomes even bigger. We might not see each other for months or years. If you need the money quickly, that's no good. So, how do I get you your $100 if we're in different places? In today's world, most people send money electronically, and there are plenty of ways to do it. I could send you a bank transfer, but if we're in different countries, that could take days to process. International transfers often come with hefty fees and complicated processes, especially if different currencies are involved. I could use a money transfer service like Western Union or MoneyGram, but those services charge high fees for the convenience. I could pay you using a credit or debit card, assuming you have the ability to accept card payments. But again, there are fees, and not everyone has access to card processing. We could use PayPal or a similar service, but that introduces yet another middleman into the process. PayPal holds your funds, can delay payments, and even freeze your account for various reasons. No matter which method I choose, there's always an intermediary, a third party that processes the transaction. That means we have to trust that third party to process the payment correctly. There are usually delays before the money actually arrives. We often have to pay fees for the service. Wouldn't it be great if there was a way to send digital money directly peer-to-peer without needing a bank, payment service, or middleman? And that brings us to Bitcoin, because that's exactly what Bitcoin was designed to do. What is Bitcoin? Bitcoin is a form of digital cash that allows people to send and receive money peer-to-peer, just like handing someone a $100 bill, except you don't need to be in the same place. With Bitcoin, you can send money directly to someone anywhere in the world. No banks, no payment processors, no middlemen. The transaction is fast. It's borderless. You can send Bitcoin to someone on the other side of the world just as easily as sending it to your neighbor. It's decentralized, meaning no single company, government, or entity controls it. Bitcoin works on a global network of computers that verify and record transactions. Instead of needing a bank or financial institution to approve payments, Bitcoin transactions are validated by this decentralized network. Why is Bitcoin important? Bitcoin is more than just another way to send money. It's a revolutionary change in the way money itself works. Right now, banks and financial institutions control most of the world's money. They decide who can send money, how much they can send, and when they can send it. They charge fees, enforce restrictions, and can even block transactions if they choose to. Bitcoin removes the need for permission. With Bitcoin, anyone with an internet connection can send and receive money freely without needing approval from any bank, government, or payment provider. Bitcoin is also limited in supply, unlike traditional money, which can be printed endlessly by governments. This makes it a scarce asset, similar to gold. Let's recap topic number 1 for a second. At its core, Bitcoin is a solution to the problems of traditional money. It allows people to transfer value instantly, securely, and without needing to trust a third party. It's like digital cash that works across borders and is resistant to control by banks or governments. And while it may seem complex at first, the basic idea is simple. Bitcoin is money that only you control. Now that we've covered the basics of what Bitcoin is, let's dive deeper into how it actually works. But before we do that, make sure to follow me on Twitter. Link is down in description, and here is my username. Why Twitter? Well, Twitter is #1 social media for crypto-related information. You absolutely want to have it, because in crypto, everything is about information. Those who have early informations are the ones that make money. Okay, moving on to topic number 2, which is how Bitcoin actually works. Bitcoin isn't just some digital asset floating around on the internet. It's a powerful online network that enables value to be transferred across the internet between individuals without the need for an intermediary. Bitcoin, with a capital B, refers to the network itself, the decentralized system that enables transactions to occur. On the other hand, Bitcoin, with a lowercase b, refers to the currency that exists on the Bitcoin network. The ticker for Bitcoin is BTC, and we will use it from now on when we want to refer to the currency itself to avoid any confusion. BTC ticker symbol is used in exchanges and financial markets when people trade Bitcoin. You will be able to see it if you ever visit any cryptocurrency exchange. Now, who created Bitcoin? Bitcoin's origins are mysterious, to say the least. It was created by an unknown individual or group who went by the name Satoshi Nakamoto. To this day, nobody knows who Satoshi really is, or even if he is actually a single person or a group of developers. On October 31st, 2008, Satoshi published a groundbreaking document known as the Bitcoin White Paper. The paper was titled Bitcoin, a peer-to-peer electronic cash system, and its very first line set the stage for the revolution. A purely peer-to-peer version of electronic cash would allow online payments to be sent directly from one party to another without going through a financial institution. That sentence alone encapsulates Bitcoin's core idea, removing financial institutions from the equation and allowing people to transact freely over the internet. Satoshi had an incredibly difficult challenge ahead. How do you create a system that allows people to transact digitally over the internet without needing a trusted third party to keep track of everything? In the traditional financial system, banks act as record keepers. They ensure that when you send money, you actually have that money. They also prevent double spending, meaning you can't use the same funds twice. But if you remove the banks, who keeps track of transactions? How do you make sure people only spend what they actually have? And, more importantly, how do you eliminate the need for trust in the first place? Let's be honest, people, when given the opportunity, often act out of self-interest. If there's a loophole that lets them spend digital money multiple times or create money out of thin air, some will try to exploit it. So without banks to verify balances, how do you make sure Bitcoin remains secure and honest? To understand why Bitcoin's solution is revolutionary, let's once again look at how traditional money works. Physical cash. Paper money is difficult to forge, and if you try, you'll likely face serious punishment. That's how governments enforce the integrity of physical currency. Electronic transactions. When you use a debit or credit card, the bank updates its central records to ensure you don't spend more than you have. Central banks. The financial system depends on central banks to issue and regulate money. However, they can also print more at any time, which devalues the currency over time. And that's exactly what has been happening in recent years. Satoshi figured out a brilliant way to create a decentralized financial system without the need for banks. Instead of relying on a single entity to keep track of transactions, Bitcoin is engineered so that every computer running the Bitcoin software keeps a complete record of all transactions. These computers are known as nodes. A node is simply a computer that is downloaded and is running the Bitcoin software. Think of it like this. Each node acts as an independent bookkeeper, recording every transaction that happens on the network. So rather than one central database controlled by a bank, Bitcoin uses a distributed ledger, a shared record of transactions that is constantly updated and verified across thousands of nodes around the world. This means no single point of failure. If one node goes offline, the network continues without issue. No central authority, no bank, government, or institution controls the system. Security through decentralization. Every node checks and verifies transactions, ensuring no one can cheat the system. With traditional banking systems, all financial records are stored in centralized databases. This creates huge risks. If a hacker gains access to a bank's database, they could alter or delete all records. Fraud and corruption. A centralized authority has full control over records, meaning transactions could be manipulated or censored. Dependence on trust. You have to trust that your bank is keeping honest records and won't block or restrict access to your own money. Bitcoin removes these risks by distributing its ledger across thousands of independent nodes. How Bitcoin transactions are secured. Every transaction on the Bitcoin network is checked and verified by nodes. Transactions are validated to ensure no one is double spending BTC. Every few minutes, new transactions are bundled together into a block. These blocks are linked together to form an unchangeable record of transactions. This brings us to one of Bitcoin's most important security features, the blockchain and hashing. Each new block of transactions is linked to the previous one using a cryptographic technique called hashing. Without getting too technical, this means that every block is mathematically connected to the one before it. Why is this important? Because if someone tried to alter a past transaction, say, to give themselves more BTC than they actually have, this change would break the cryptographic link between blocks. And here's the key. The network would immediately detect and reject the fraudulent change. This is what makes the Bitcoin blockchain an immutable record of transactions. Unlike centralized banking systems, where records can be altered, censored, or even erased, Bitcoin's blockchain is permanent and tamper-proof. Satoshi Nakamoto didn't just create a new currency, he created an entirely new way for people to store and transfer value without relying on banks, governments, or financial institutions. Bitcoin network system ensures that no one can alter the transaction history. No central authority can freeze or block payments. Transactions are verified by the network, not by a single company or institution. It's a fundamentally new model for money, one that removes the need for trust and replaces it with mathematical security. And that's why Bitcoin isn't just another digital currency, it's a revolution. Moving on to topic 3, which is about nodes and miners. By now, you might be wondering, why are nodes making sure that transactions are processed correctly? Why are they verifying balances? What's in it for them? As we've already seen, Bitcoin operates on a decentralized network of nodes/computers running the Bitcoin software that store a full copy of the blockchain and help validate transactions. Running a Bitcoin node is actually a pretty straightforward process. You don't need a supercomputer or specialized hardware. In fact, a basic computer with decent storage space is enough to do the job. However, there's no financial reward for running a node. Unlike miners, which we'll get to shortly, regular nodes don't receive any BTC for their efforts. Instead, their reward is more ideological. They help keep the Bitcoin network secure. They contribute to its decentralization. They ensure that transactions remain trustless and transparent. The more nodes there are, the more independent bookkeepers exist across the network, making Bitcoin even harder to attack or manipulate. But while nodes play an essential role in maintaining the system, there's another type of participant in the Bitcoin network, one that has a financial incentive to keep it running. These are the miners. You've probably heard the term Bitcoin mining, but it might not be immediately clear what mining has to do with an asset that exists purely in digital form. After all, mining usually involves digging things up from the earth: gold, silver, coal. But Bitcoin isn't a physical commodity, so what exactly is being mined? The answer lies in Bitcoin's monetary policy, the way new BTC is introduced into the system. Unlike traditional currencies, which can be printed indefinitely by central banks, Bitcoin has a hard limit on its total supply. Only 21 million BTC will ever exist. That's it. No more. Ever. But these 21 million BTC weren't all created at once. Instead, they are gradually released over time. And that's where mining comes in. New BTC enters circulation through a process known as the block reward. Every time a new block of transactions is added to the blockchain, a fixed number of BTC is created and awarded to the miner who successfully mines that block. This reward serves two purposes. One, it acts as an incentive for miners to contribute their computing power to secure the network. Two, it introduces new BTC into circulation in a controlled, predictable manner. But here's the key. The block reward isn't constant. Bitcoin's code was designed to reduce the reward over time, a process known as the halving. Approximately every 4 years, the number of BTC miners received for successfully mining a block is cut in half. This slows down the rate at which new BTC enters circulation, reducing inflation over time and ensuring Bitcoin remains scarce. This is fundamentally different from traditional money, where governments can print more and more currency, devaluing what already exists. Miners don't just secure the network for the sake of earning rewards, they also play a crucial role in keeping Bitcoin honest. This entire system of mining, competition, and block rewards is part of what's called proof of work. But what exactly does that mean? Bitcoin miners are all competing for the right to add the next block to the blockchain and claim the BTC block reward. But how do they win? It all comes down to solving a cryptographic puzzle, a mathematical challenge that requires miners to guess a random number. Now, this isn't just any number. It's a massive number with so many digits that there's no way to just figure it out through logical deduction. Instead, miners must rapidly guess trillions of possibilities until one of them gets lucky and finds the correct answer. The first miner to guess the number correctly gets to add the next block of transactions to the blockchain, claim the newly minted BTC block reward, collect transaction fees from all the transactions included in that block. Once a block is mined, the whole process starts all over again. But here's the catch. Submitting trillions of guesses takes an enormous amount of computing power, and that computing power requires a lot of electricity. Does Bitcoin mining harm the environment? This is where a lot of criticism comes in. Because Bitcoin mining consumes large amounts of energy, many people argue that it's bad for the environment. And yes, if mining were powered entirely by fossil fuels, that would be a valid concern. But here's the good news. A growing percentage of Bitcoin mining now uses renewable energy sources, such as solar power, wind energy, hydroelectricity. In fact, Bitcoin mining is increasingly being powered by energy that would otherwise go to waste, making it far more sustainable than most people think. But that's a topic for another discussion. For now, just know that while mining does require significant energy, the environmental impact depends entirely on the energy source being used, and many miners are shifting toward greener solutions. With all this talk about nodes and miners, you might be wondering, do I have to be a node or a miner to use Bitcoin? Not at all. Unlike the traditional financial system, where you need permission to open a bank account or send money, Bitcoin is open to anyone with an internet connection. No bank account required, no government approval needed, no restrictions on who you can send money to. If you have BTC, you can send it to anyone, anywhere in the world, instantly, with no middleman standing in your way. And that's one of Bitcoin's most powerful features. So to summarize, nodes help maintain the Bitcoin network, but aren't financially rewarded. Miners compete to solve cryptographic puzzles in exchange for new BTC and transaction fees. Bitcoin's total supply is fixed at 21 million, making it scarce and resistant to inflation. Mining is energy intensive, but it's increasingly powered by renewable energy. Anyone, anywhere can use Bitcoin. No banks, no middlemen, no barriers. And that's why Bitcoin isn't just a currency, it's a revolution in financial freedom. Welcome to the future of money. Topic 4, private and public keys. Bitcoin's security and functionality are deeply rooted in a concept known as public key encryption, which is one of the key reasons why Bitcoin operates as the most secure payment network on Earth. This system involves 3 critical components that work together seamlessly, allowing anyone to use the network to transfer BTC safely and effectively. Let's break it down. The very first component is the private key, which is a randomly generated string of letters and numbers created by the Bitcoin software for a new user. This private key, as the name suggests, must be kept secret at all costs. Without it, you lose access to your Bitcoin, and if someone else gets their hands on it, they can access your Bitcoin as well. Think of it as your online banking password. If someone else has it, they control your account. It's critical to understand that the private key is the key to unlocking your Bitcoin, and without it, you cannot access your funds. Later, I'll explain how private keys are stored for safekeeping. Public key. The next component in this system is the public key. Using the private key, Bitcoin software runs a complex mathematical process that generates a public key. These keys are essentially long strings of random letters and numbers. Importantly, the process that creates the public key from the private key is irreversible. This means you can generate a public key from a private key, but you can't reverse engineer a private key from a public key. This adds an extra layer of security, ensuring that your private key remains private and safe. Bitcoin address. Now, while the public key is an important part of the process, it isn't yet ready to be shared with others. Before you can share your public key with someone, another layer of mathematical processes is applied to create what's known as your Bitcoin address. This Bitcoin address is another string of numbers and letters, and it can also be represented as a QR code for easy scanning. The address itself is what others need in order to send you Bitcoin. It's similar to a bank account number in the traditional financial world. You can share this address with others, and they can use it to send Bitcoin to you over the network. In Bitcoin's early days, the process of generating private keys, public keys and addresses was a bit more complicated. Users had to rely on various online services to generate these keys, or they could download the Bitcoin Core wallet to do it themselves. It's important to understand another essential concept: Bitcoin wallets. A Bitcoin wallet is software that serves two primary functions: storing your private keys and managing your public keys, or Bitcoin address. This allows you to interact with the Bitcoin network, enabling you to send and receive Bitcoin. While modern wallets may have more features today, these two functions are the core of a wallet's purpose. The easiest and most popular way to obtain Bitcoin today is to buy it through an exchange like Coinbase or Binance. When you sign up for an exchange, it automatically creates a wallet for you. You can then deposit traditional currencies, such as US dollars, euros, or British pounds, into the exchange, use them to purchase Bitcoin, and that Bitcoin is then stored in your exchange wallet. However, here's a very important thing to understand. Because the exchange holds your wallet, it also holds the private keys for that wallet. This means the exchange controls access to your Bitcoin. Now, while legitimate exchanges typically won't misuse your private keys, there have been cases in the past where less trustworthy exchanges have done so. Even the largest exchanges, like FTX, can be compromised or act in dishonest ways behind the scenes. So, one of the most crucial things any Bitcoin holder can do is practice self-custody. This means taking control of your private keys and storing them securely yourself, rather than relying on an exchange. By doing so, you ensure that only you have access to your Bitcoin. There's a lot of information about Bitcoin to digest here. So to wrap up this introduction, let's focus on the most crucial thing you need to know if you're planning to get your hands on some Bitcoin. The first step is using a reputable exchange to buy your Bitcoin. But the next and most important step is taking custody of your private keys. This means storing them yourself. The best way to do this is by using a wallet that you control, not one hosted by an exchange or any third party. Bitcoin is designed to be trustless, meaning that it's built on the idea that you don't have to trust anyone else to handle your funds. If you're trusting someone else to hold your private keys, you're going against what Bitcoin itself is all about. Sure, trusting an exchange might be convenient, and the best exchanges do have strong security protocols, but at the end of the day, you can never be 100% sure. And getting back to banks, well, centralized crypto exchanges are closest thing to bank. You should use them, but not let them have too much power over you. Software wallets are a good option. There is a tutorial on installing those in our previous video, which you can find in description of this video. Congratulations! Now that you understand Bitcoin, you are already ahead of so many people. And if you didn't quite grasp everything, don't let it discourage you. Understanding even 20% will give you knowledge and edge to move forward. But now, let's move to number 2 cryptocurrency, which is Ethereum, or the smart queen of crypto. This is where things get interesting. Trust me, you will see it yourself once you go through Ethereum fundamentals, and we will go through them in 8 key topics. Let's start with topic number 1, which is why Ethereum exists in the first place. To understand why Ethereum exists, we need to first look at what Bitcoin could not do. Bitcoin was created as digital cash, a way to send money without the middleman, which are banks. It does this job perfectly, but imagine if your smartphone could only make calls and send texts. You wouldn't be able to use apps, browse the internet, or take photos. That was the state of blockchain technology before Ethereum came along. Bitcoin's blockchain is like a notebook that only records money transfers and inscriptions, but that is a topic for another video. Alice sends Bob 1 BTC. End of story. It pretty much can't handle anything more complex. This limitation exists by design. Bitcoin keeps things simple to stay secure and fully decentralized. But this simplicity means it can't create contracts, build applications, or automate agreements. The world needed a blockchain that could do more than just payments. This is where Ethereum comes in. Created by Vitalik Buterin in 2015, Ethereum was designed as a programmable blockchain. Think of it like a computer that runs on a global network instead of a single machine. While Bitcoin handles money, Ethereum handles money plus logic. It can execute what we call smart contracts, which are self-operating agreements written in code. Let me give you a real-world example. Imagine renting an apartment. Normally, you'd need to sign a lease, pay a security deposit, and trust the landlord to return it when you leave. With Ethereum, you could create a smart contract that automatically holds your deposit and releases it back to you when your rental period ends, if all conditions are met. No need to trust or chase anyone. The code handles it. This simple idea opened up endless possibilities. For the first time, developers could build entire applications that run on blockchain. These aren't like normal apps that live on Apple's or Google's servers. They run on Ethereum's decentralized network, meaning no single company controls them or can interfere with them. This created entirely new categories like decentralized finance, where you can borrow, lend, and trade without banks, and NFTs, which serve as proof of ownership for digital items. Before Ethereum, if you wanted financial service online, you needed to work through banks and government payment processors. Now, developers can build these services directly on Ethereum. A lending app can connect borrowers and lenders worldwide without a bank in the middle. An artist can sell digital artwork directly to collectors with automatic royalty payments built in. The key innovation was making blockchain programmable. Bitcoin gave us digital money that doesn't require trust in banks. Ethereum took this further by giving us digital agreements that don't require trust in any middleman. This is why Ethereum has become the foundation for an entire ecosystem of applications that are changing how we interact with money, contracts, and even online identity. To put it simply, if Bitcoin is like email, a way to send messages directly without going through the post office, then Ethereum is like the entire internet built on top of email. It's not just a tool, but a platform for building new tools. This is why Ethereum has grown to become the second largest cryptocurrency, and that is why understanding it gives you such an advantage in the crypto space. In our next topic, we'll compare Ethereum and Bitcoin directly, so you can see exactly how they differ in their design and purpose. But already, you can see why the world needed more than just Bitcoin. We needed a blockchain that could do more than just send money from point A to point B. Topic number 2, comparing Bitcoin and Ethereum. Now that we understand why Ethereum was created, let's compare it directly to Bitcoin. Many beginners think they're just two versions of the same thing, but that's like comparing a bicycle to a motorcycle. Both get you from point A to point B, but one can do much more. All right, let's break it down into 3 key areas: transactions, security, and flexibility. First, transactions. On Bitcoin, a transaction is simple. It's just a record of someone sending Bitcoin to someone else. That's it. On Ethereum, a transaction can be much more complex. It could involve executing a smart contract, minting an NFT, or interacting with a decentralized app. This is why Ethereum transactions require more data and often cost more in fees, which we'll cover in topic 4. Second, security. Bitcoin uses a system called proof of work, where miners solve complex math problems to validate transactions. This makes Bitcoin extremely secure but uses a lot of energy. Ethereum used to work the same way, but recently switched to proof of stake, where validators lock up Ethereum to secure the network. This reduced Ethereum's energy use by 99%, which we'll explore in topic 5. Third, flexibility. Bitcoin's scripting language is intentionally limited to keep it secure and simple. Ethereum's programming language is much more flexible, allowing developers to build almost any application they can imagine. This flexibility is why Ethereum has become home to decentralized finance, NFTs, and thousands of other applications. Here's a real-world example to show the difference. Imagine you want to send money to a friend overseas. With Bitcoin, you can send the money directly without a bank. That's great. But what if you want to add conditions? Maybe you only want the money sent if your friend arrives safely, or you want to split it between multiple people automatically. Bitcoin can't do that. Ethereum can, through smart contracts. Another big difference is speed. Bitcoin processes about 7 transactions per second. Ethereum currently handles about 30, though upcoming upgrades aim to increase this significantly. This might not sound like much compared to XRP's 1,500 transactions per second. But remember, these are global networks that don't rely on any central authority. The communities behind each project also have different philosophies. Bitcoiners tend to prioritize security and decentralization above all else. The Ethereum community is more willing to make changes and upgrades to enable new features. This is why Ethereum evolves faster, though some argue this makes it less stable than Bitcoin. To summarize, Bitcoin is like digital gold, a store of value and medium of exchange. Ethereum is like digital oil, powering a vast ecosystem of applications. Bitcoin is the more conservative, stable option. Ethereum is the more experimental, flexible platform. Understanding this difference is crucial because it affects how you might use each one. If you just want an alternative to traditional money, Bitcoin might be enough. But if you want to explore decentralized apps, smart contracts, or the future of finance, you'll need Ethereum. In our next topic, we'll dive into smart contracts, the revolutionary feature that makes all of Ethereum's advanced functionality possible. This is where things get really interesting. because smart contracts are what turn Ethereum from just a cryptocurrency into an entire programmable economy. Topic number 3, explaining smart contracts. Smart contracts are what make Ethereum special. They're not just a feature, they're the foundation of everything Ethereum does. But what exactly are they? Let me explain it in the simplest way possible. A smart contract is like a vending machine for agreements. You put in your money, select what you want, and the machine automatically gives it to you. No cashier needed, no trust required. The rules are built into the machine itself. That's exactly how smart contracts work on Ethereum, except they can handle much more than just snacks. Here's how they work in practice. A smart contract is a set of instructions written in code that lives on the Ethereum blockchain. Once deployed, it runs exactly as programmed. No one can change it, stop it, or interfere with it. The contract executes automatically when certain conditions are met. Let's look at a concrete example. Imagine you're buying a house. Normally, you'd need lawyers, banks, and escrow services to handle the transaction. With a smart contract, you could program the entire process in 3 steps. Here is an example. Step number 1, the buyer deposits the purchase amount into the contract. Step number 2, the seller provides digital proof of ownership. Step number 3, when both conditions are met, the contract automatically transfers the money to the seller and the ownership to the buyer. No banks taking days to process the transaction. No lawyers charging fees. No risk of either party backing out. The contract handles everything automatically based on the rules written into its code. This might sound simple, but the implications are enormous. Smart contracts eliminate the need for middlemen in all kinds of transactions. Here are some examples that you might be familiar with of what smart contracts can do. Number 1, automate insurance payouts when flight delays occur. Number 2, manage supply chains by releasing payments when goods arrive. Number 3, create decentralized organizations that run without CEOs. Number 4, handle payroll by paying employees exactly when they complete work. You don't need to trust the other party. You just need to trust that the code will execute as written. And since the code is public on the blockchain, anyone can verify how it works. This technology has already created trillion-dollar industries. Decentralized finance or DeFi platforms use smart contracts to recreate banking services without banks. NFT marketplaces use them to handle digital ownership. Even traditional companies are starting to use them for things like royalty payments and supply chain management. Let me explain one example I like to use when people ask me about NFTs. You know about luxury watch company called Rolex. Well, Rolex has huge problems with copies being made all around the world, which damages their revenue and image. Now imagine if Rolex just created one smart contract for every series of Rolexes being made, and each watch gets correlating NFT. So you buy watch and you receive NFT, which stores all information proving that that watch is original. Then when you want to resell it, buyer receives that NFT along with the Rolex watch. And boom, no more possibility for fake Rolex to pass as original, because it is impossible to interfere with their smart contract. One more thing that makes Ethereum's smart contracts special is that they're composable. This means different contracts can work together like Lego blocks. Developers can build on top of existing contracts to create complex systems. This composability is why Ethereum has become the foundation for so many applications. Of course, smart contracts aren't perfect. If there's a bug in the code, bad things can happen. And since contracts can't access real-world data on their own, they need something called oracles to feed them information, which introduces some form of centralization, which is against crypto philosophy, but it is necessary in order to create complex systems on blockchain. But despite these challenges, smart contracts represent a fundamental shift in how we make agreements. They're creating a world where business logic can be automated, where intermediaries become optional, and where trust is established through code rather than institutions. In our next topic, we'll look at gas fees, which are the cost of running these smart contracts and transactions on Ethereum. Because while smart contracts are powerful, they're not free to use. And understanding how gas fees work is crucial for anyone using Ethereum. Topic number 4, how gas fees and transactions work. If you've ever tried using Ethereum, you've probably noticed that every transaction costs something. This isn't arbitrary. There are important reasons why Ethereum can't be completely free to use. Think of gas fees like the fuel that keeps Ethereum running. Just like your car needs gasoline to drive, every operation on Ethereum requires gas to execute. This includes sending ETH, interacting with smart contracts, or interacting with NFTs. The more complex the operation, the more gas it requires. Here's how it works in practice. When you want to make a transaction on Ethereum, you specify two things: the gas limit, which is how much computational work you're willing to pay for; the gas price, which is how much you're willing to pay per unit of gas. The total fee is gas limit multiplied by gas price. And don't let it scare you if you don't understand it, because this process is done automatically. And unless you are looking to become a blockchain developer, you will never need to do this manually. But the more you know and understand, the better. This system serves three crucial purposes. First, it prevents network spam. Without fees, someone could flood Ethereum with meaningless transactions and crash the network. Fees ensure that only serious and important transactions get processed. Second, it compensates validators. These are the people who run Ethereum's infrastructure and verify transactions. Gas fees are their incentive to keep the network secure and operational. Third, it allocates resources fairly. When the network is busy, users who need their transactions processed quickly can pay higher fees to jump the queue. Let me give you a real-world comparison. Imagine Ethereum is a highway and transactions are cars. Gas fees are like tolls. When the highway is empty, tolls are cheap, but during rush hour, tolls increase to manage traffic. Some drivers who pay higher tolls get to use the express lanes. Or just think about private jets. You pay much more money than regular airline ticket costs. But in return, you save so much time. The price of gas isn't fixed. It changes based on network demand. During peak times like NFT drops or major DeFi launches, gas fees can spike dramatically. We've seen times when simple transactions cost over $100 in fees. This is one of Ethereum's biggest challenges that its developers are working to solve. There are some important differences between how Bitcoin and Ethereum handle fees. Bitcoin fees are based solely on transaction size in bytes value. Ethereum fees are based on computational complexity. A simple Ethereum transfer might use 21,000 gas units. A complex DeFi transaction could require 500,000 plus gas units. This is why Ethereum transactions can sometimes cost more than Bitcoin transactions. They're often doing much more work behind the scenes. Here's a practical tip for new users. If your transaction isn't urgent, you can set a lower gas price and wait for network activity to decrease. Wallets like MetaMask often suggest appropriate gas prices based on current conditions. And once again, make sure to check our 24-minute course for crypto beginners, which will even teach you how to create MetaMask wallet in few simple steps. It costs nothing. Looking ahead, Ethereum's upcoming upgrades aim to make gas fees more predictable and affordable. But the fundamental principle will remain. Using Ethereum's global computer will always have some cost, because maintaining a decentralized network isn't free. In our next topic, we'll explore how Ethereum recently transformed its security model with proof of stake, cutting its energy use by 99% in what's been called one of the most ambitious upgrades in crypto history. Topic number 5, proof of stake. Ethereum recently underwent one of the most significant changes in crypto history. In September 2022, after years of development, Ethereum successfully transitioned from proof of work to proof of stake. This wasn't just a small upgrade, it completely transformed how Ethereum operates while solving one of its biggest criticisms, which is energy consumption. Let's start by understanding what proof of stake actually means. Under the old proof of work system that Bitcoin still uses, miners competed to solve complex math problems to validate transactions. This required massive amounts of electricity. At its peak, Ethereum was using as much energy as a small country. Proof of stake changes this dramatically. Instead of miners, we now have validators. These validators don't solve math problems, they simply lock up or stake their Ethereum to participate in securing the network. The more Ethereum you stake, the higher your chances of being chosen to validate transactions and earn rewards. Here's how it works in practice. First, to become a validator, you need to stake at least 32 Ethereum. This is like putting down a security deposit that proves your eligibility. Second, validators are randomly selected to propose new blocks of transactions. The selection isn't completely random. Those who stake more Ethereum have better odds, but there's always an element of chance. Third, other validators verify the proposed block. If enough agree it's valid, the block gets added to the blockchain and the validator receives a reward. Fourth, if a validator tries to cheat or approve fraudulent transactions, they can lose part or all of their staked Ethereum. This is called slashing, and it's what keeps validators honest. The benefits of this system are enormous. First, energy efficiency. Proof of stake reduced Ethereum's energy consumption by over 99%. Validating transactions now uses about the same energy as a large home computer rather than an industrial mining operation. Second, accessibility. Under proof of work, mining required expensive specialized hardware. Now, anyone with 32 Ethereum can participate in securing the network. Third, security. The economic incentives make attacking the network extremely costly. To manipulate transactions, you'd need to control at least 51% of all staked Ethereum, an amount that would cost enormous amount of dollars to acquire. Fourth, scalability. Proof of stake lays the foundation for future upgrades that will help Ethereum handle more transactions per second. Let me give you a real-world comparison. Proof of work is like a lottery where everyone buys tickets by solving math problems, which burns energy. Proof of stake is like a lottery where your chances depend on how much money you're willing to lock up as collateral, which uses minimal energy. There are some concerns worth mentioning. First, proof of stake favors those with more Ethereum, potentially leading to centralization among large holders. Second, the 32 Ethereum requirement makes it difficult for average users to participate directly. Third, the system is still relatively new compared to Bitcoin's battle-tested proof of work. Despite these concerns, the transition has been remarkably smooth. Today, over 26 million Ethereum, which is worth tens of billions of dollars, is staked, securing the network. The environmental benefits alone make this one of the most important developments in crypto history. Looking ahead, proof of stake enables further upgrades to Ethereum's architecture, which we'll explore in our final topics. But first, in our next section, we'll examine how all these technical foundations support Ethereum's most exciting use cases, the trillion-dollar world of decentralized finance and applications. Topic number 6, decentralized finance and decentralized applications. Now we arrive at the most exciting part of Ethereum, the real-world applications that are transforming finance and the internet as we know it. These aren't just theoretical concepts anymore. Today, there's an entire parallel financial system running on Ethereum that handles billions of dollars every day, all without banks or traditional institutions. Let's start with decentralized finance, or DeFi. Imagine being able to borrow money, earn interest, or trade assets without ever dealing with a bank. That's exactly what DeFi makes possible. Here's how it works. Instead of banks holding your money and controlling transactions, smart contracts create financial services that anyone in the world can access. You interact directly with the code through your crypto wallet. No account applications, no credit checks, no business hours. Some of the most popular DeFi applications include decentralized exchanges that let you trade crypto without signing up for an account. These platforms have processed over $1 trillion in trades. Lending protocols where you can earn interest by depositing crypto, often at rates much higher than traditional banks offer. Stable coins, which are cryptocurrencies pegged to real-world assets like the US dollar that provide stability in the volatile crypto market. Insurance platforms that protect against smart contract failures or exchange hacks. All of these services run 24/7, with transactions settling in minutes rather than days. And they're available to anyone with an internet connection, regardless of location or banking status. Now let's talk about decentralized applications, or DAPPs. These are like normal apps you use every day, but with one crucial difference. They run on Ethereum's blockchain instead of company servers. This means no single entity controls them. They can't be censored or shut down. They often have built-in payment systems using cryptocurrency. Some groundbreaking DAPPs include marketplaces for digital art and collectibles that have generated billions in sales, decentralized social media platforms where users control their data and earn rewards for participation, gaming platforms where players truly own their in-game items as NFTs that can be bought and sold, supply chain tracking systems that provide transparent records of product origins. The numbers behind this ecosystem are staggering. At its peak, the total value locked in DeFi protocols exceeded $150 billion. Popular DAPPs routinely handle millions of users and billions in transactions. And this is just the beginning. What makes Ethereum so powerful for these applications is composability, the ability for different smart contracts to work together seamlessly. Developers can mix and match existing protocols like financial Lego blocks to create new services. An application might combine a lending protocol, decentralized exchange, and yield aggregator to offer sophisticated financial products that would be impossible in traditional finance. Of course, this new frontier comes with risks. Smart contract bugs have led to hundreds of millions in losses. Scam projects abound in the unregulated space, and the complexity can be daunting for newcomers. but the potential is undeniable. Ethereum is enabling new business models for creators and internet services that put users in control. As the technology matures and becomes more user-friendly, we're likely to see even more innovative applications emerge. In our next topic, we'll examine the challenges Ethereum faces as it grows, from technical limitations to regulatory uncertainty. Because while the potential is enormous, the path forward isn't without obstacles. Which bring us to topic number 7, Ethereum's biggest challenges. For all its revolutionary potential, Ethereum faces significant hurdles that could determine its long-term success. Let's examine the 3 biggest challenges standing between Ethereum and mass adoption. First challenge is scalability issues. Ethereum currently processes about 30 transactions per second. Compare that to XRP's 1,500, and you see the problem. During peak times, the network becomes congested, sending gas fees skyrocketing to hundreds of dollars per transaction. This makes simple interactions prohibitively expensive for regular users. The Ethereum team is working on solutions through upgrades like sharding, which is splitting the network into smaller pieces, Layer 2 solutions, which are secondary networks that batch transactions, and continued optimizations to the base layer. But these fixes take time, and until they're fully implemented, Ethereum struggles with its own success. When applications go viral, they often become unusable due to network congestion. Second challenge is rising competition. Other blockchains have emerged promising faster speeds and lower fees. Solana boasts 65,000 transactions per second, and our next video will be explaining Solana. So once again, make sure to subscribe if you don't want to miss it. Avalanche offers sub-second finality. Even Bitcoin is getting smart contract capabilities through Layers 2 options like stacks. These competitors have attracted developers and users with near-instant transactions, fees costing fractions of a penny, and developer-friendly environments. While Ethereum still dominates in total value locked-in developer activity, the competition is forcing rapid innovation. The risk is fragmentation, where no single blockchain achieves critical mass because users are spread too thin across dozens of networks. Third challenge is regulatory uncertainty. Governments worldwide are scrambling to understand and regulate decentralized finance. Key concerns include tax compliance for DeFi transactions, consumer protection against scams and hacks, anti-money laundering enforcement. The biggest threat is the potential classification of Ethereum as a security rather than a commodity. This could subject it to much stricter regulations that might limit who can buy and trade Ethereum, force changes to how staking works, create compliance burdens for developers. Recent actions against crypto companies suggest regulators are taking a harder line. How Ethereum navigates this landscape will significantly impact its future. Additional challenges worth noting. User experience remains too technical for mainstream adoption. Environmental concerns persist despite proof-of-stake transition. Centralization risks in staking pools and Layer 2 solutions. The path forward isn't easy, but Ethereum's strong developer community and first-mover advantage give it a fighting chance. Upcoming upgrades aim to address many of these issues, which we'll explore in our final topic about Ethereum's future. What's clear is that solving these challenges will require balancing 3 competing priorities: maintaining decentralization, the core ethos of crypto, achieving scalability in order to support mass adoption, and ensuring security in order to protect billions in value. In our final section, we'll look at Ethereum's roadmap and why many believe its best days are still ahead. The solutions to these challenges could determine not just Ethereum's future, but the future of the entire blockchain industry. Topic number 8, the future of Ethereum. Ethereum stands at a crossroads. It has already revolutionized blockchain technology, but its greatest achievements may still lie ahead. The next few years will determine whether Ethereum becomes the foundation for a new internet and financial system or gets overtaken by faster, more efficient competitors. So what does the future hold? Let's break it down into 3 key areas: upgrades, adoption, and long-term potential. First, upgrades. Ethereum's development roadmap, known as Ethereum 2.0 or the merge, which already happened, was just the beginning. The next major phases include dank sharding, a scaling solution that will split Ethereum into smaller chains, increasing transaction capacity exponentially. Proposer-builder separation, or PBS, which aims to reduce centralization risks in block production. Account abstraction, making wallets smarter and more user-friendly, so interacting with Ethereum feels as simple as using a regular app. These upgrades could finally solve Ethereum's scalability issues, bringing fees down to cents instead of dollars and supporting millions of users seamlessly. Second, adoption. Ethereum's real-world use is growing faster than ever. Major companies like Visa and PayPal are experimenting with Ethereum-based settlements. Governments are exploring central bank digital currencies, or CBDCs, built on Ethereum's tech. Even traditional finance is embracing DeFi, with institutions using Ethereum for everything from bond issuance to derivatives trading. But the most exciting adoption is happening at the grassroots level. Artists, gamers, and entrepreneurs are building entirely new economies on Ethereum. Imagine a future where your social media profile is an NFT owned by you and portable across platforms. Your paycheck arrives via a smart contract instantly and without bank delays. You borrow money against your crypto holdings without credit checks or paperwork. This isn't science fiction. It's already happening in early forms today. Third, long-term potential. Ethereum's ultimate goal is to become a world computer, a decentralized backbone for the next generation of the internet. If successful, it could replace today's tech giants with open protocols where users control their data, identity, and finances. But success isn't guaranteed. Ethereum must overcome its challenges while staying true to its decentralized roots. The next few years will be critical. If upgrades roll out smoothly, adoption could explode. If delays or regulatory crackdowns happen, competitors might gain ground. Once again, let me congratulate you on making it this far through the video. The more you hear, the more you know. And the more you know, more chance for you to succeed in world of crypto. It is simple math. Now let's dive into XRP, or as I like to call him, Prince of Banking. To understand XRP, we will go through 8 key topics. Okay, diving into topic number 1. Why should you care about Ripple? All right, just imagine you are doing a freelance remote job for a client from, let's say, United Kingdom, and your residence is California, for example. You finish the job, and client now needs to pay you, let's say, $1,000. He would need to transfer his British pounds to US dollars while paying fees. Then he would need to send money from his bank account to your bank account, which will also cost fees. It is fair to estimate that both you and him will lose at least $25 each paying fees to your banks. When you add that up, that would be 5% of total sum you earned. So to better understand this injustice, let's put it into perspective of time. Let's say you invested 20 hours of your work in this job. That would mean that 1 total hour you work just so bank can give you your money. I believe we all agree that this is insane. And that's not all. On top of that, you would most likely need to wait at least 3 to 5 days for money to even arrive. Imagine in this day and age, you need to wait for some balance numbers on some computer to travel to another computer takes 3 to 5 days. Wait, you don't need to imagine. That is exactly how international money flow works. To put it simply, it is a broken system. And that is exactly where XRP comes in. It is the revolutionary way to send money globally. But instead of 3 days, it takes maximum of 3 seconds. Instead of $50 fees, it costs less than 5% of 1 penny. And instead of ancient banking system, it is running on a network that works 24/7. Sounds mind-blowing. Don't worry, just sit back and relax. Because as we go through, information will get even more mind-blowing. Which brings us to topic number 2. What is Ripple? In order to start this one, we need to clear out one of the biggest confusions around Ripple and XRP. And we just said it. Ripple and XRP are not the same thing. Ripple is the company, and XRP is simply the cryptocurrency that they created. Think of it like FedEx. Ripple would be the FedEx company itself, and XRP in this case would be the trucks they use in order to do business of delivering goods. To put it simply, XRP is just the product that was made by Ripple Company. Okay, now, let's head into the vision of Ripple. Ripple was created in order to revolutionize outdated banking systems all around the world. As we said in previous step, banking systems are super outdated. But why is that the case? Well, it is simple. Like everything in world, it also revolves around money and control. You see banking systems today use a system called SWIFT, which stands for Society for Worldwide Interbank Financial Telecommunication. It was founded in 1973 by a total of 239 banks from 15 different countries in order to replace Telex, an outdated error-prone system. In 1977, it launched operation with 518 banks. Today, it is used by more than 11,000 institutions in over 200 countries, with a daily volume that surpasses $5 trillion. So we can say that SWIFT did monopolize a huge percentage of the money flow in the entire world. So if you're asking yourself, why aren't banking systems getting Ripple technology instead of SWIFT? The answer is right here. Nobody is going to give up $5 trillion in daily volume without a fight. In fact, They are not only not changing outdated system with revolutionary one that Ripple offers, they even tried to shut this company completely. But more about that in topic number 6. One more thing you should know about Ripple until we move on. It was founded by Brad Garlinghouse, which is the CEO of Ripple. He used to work at AOL and Yahoo. You can consider him a tech veteran that is trying to revolutionize and make banking systems more fair for everyone. Before we move on, let's recap this topic in one sentence. Ripple is a company, and it uses XRP, which is a currency they created in order to replace outdated money transfer system called SWIFT. All right, moving on to topic number 3, which is what is XRP? We already mentioned some things about XRP. Now let's dive a bit deeper inside. Let's compare XRP to other famously known cryptocurrencies. So if we consider Bitcoin as a digital gold, XRP would be closest thing to supersonic jet, simply because it is aiming to speed up international money flow by more than 10,000 times. So Bitcoin network uses proof of work, which are nodes and miners that validate every transaction, which requires computing power in order to work properly. And everyone with internet connection can participate in this. On the other hand, XRPL, which is a network where XRP exists, uses a consensus ledger, which is a group of 150 plus trusted validators working with Ripple Company. These validators validate transactions every 3 to 5 seconds. So unlike Bitcoin, which is fully decentralized and no governing body has any power over it, XRP is centralized. Otherwise, it wouldn't make sense for banks even to consider adopting it. Next comparison would be transaction speed. Bitcoin network can proceed around 7 transactions per second, while XRPL can proceed 1,500 transactions per second. Fees for sending Bitcoin can be even $10 or $20 when network is busy, while fees for sending XRP are not more than 5% of 1 penny. So to put it all in simple perspective, XRP is a centralized cryptocurrency owned by a Ripple company, existing on XRPL network. Transactions are getting validated by trusted validators. It can process up to 1,500 transactions per second with insanely low fee costs. Now let's move on to topic number 4, which will explain how banks plan to use XRP. We answered huge part of this topic in previous 3, but let's go a step further by setting up examples to clarify efficiency once again. We will make an example of moving $1 million from bank in Japan to bank in United States. In first example, we will show how it would work inside current SWIFT system banks are using. And in second one, we will show how it would look like with XRP. So in case of using SWIFT, it would go like this. Bank A in Japan would initiate transfer via SWIFT to Bank B in United States. Step 2 would need to include 2 to 3 different banks in order to handle currency conversion and routing. Step 3 would need to include pre-funded accounts. Bank A must pre-deposit Japanese yen in USA in order to prove liquidity of initiated transfer. Step 4. Bank B in United States receives US dollar after clearing delays. Whole process would take 3 to 5 days due to time zones, manual checks that need to be done, and intermediary movements. It would cost $30 to $50 of visible fees and hidden FX spread, which is an extra fee disguised as a worse exchange rate than the real market rate, which is ranging from 1 to 3%. So let's take middle, 2%. In case of $1 million transfer, that would be $20,000. Making our total fee costs $20,050. Now let's see how that would look like with XRP. Step number 1 would be for Bank A in Japan to exchange Japanese yen for XRP on XRPL network, which would take around 3 seconds. XRP then zips to USA in less than 3 seconds. Bank B receives XRP in USA and exchanges it for US dollar in less than 3 seconds. Done. No middleman, no pre-funded accounts. Whole process takes less than 10 seconds. Now fees. Fee for sending XRP is less than 5% of 1 penny, no matter the amount you are sending, and hidden FX spread would be around $5. So answer me in comment section, which way sounds better and more efficient? Now you understand why banks are itching to kick out SWIFT and adopt XRP. All right, we compared banking systems. Now let's compare XRP with top cryptocurrencies like Bitcoin and Ethereum, which brings us to topic number 5. To understand the differences properly, we need to look at 3 main aspects, which are speed, cost, and purpose. First, let us talk about Bitcoin. Bitcoin was created as digital gold, meaning its main purpose is to store value over time. When you send Bitcoin, it can take anywhere from 10 minutes to over an hour to confirm, especially when the network is busy. The fees for sending Bitcoin can range from $1 to $50, depending on network congestion. Bitcoin uses a system called proof of work, which requires massive amounts of energy to secure the network, making it less environmentally friendly. The key thing to remember is Bitcoin is fully decentralized, meaning no single company or entity controls it. Now let us look at Ethereum. Ethereum is like a global computer designed to run smart contracts and decentralized applications. Transactions on Ethereum take about 15 seconds to process, but can sometimes be slower if the network is overloaded. The fees known as gas fees can vary wildly, from 10 cents to over $20. Ethereum recently switched to proof of stake, which uses less energy than Bitcoin, but still consumes more power than XRP. Ethereum's main strength is its flexibility, allowing developers to build all kinds of applications on top of its blockchain. Finally, we have XRP. Unlike Bitcoin and Ethereum, XRP was built for one thing: moving money fast. Transactions settle in 3 to 5 seconds no matter what. The cost to send XRP is a fraction of a penny, literally less than 5% of 1 penny. XRP uses a unique consensus mechanism that does not require mining or staking, making it extremely energy efficient. While it is more centralized than Bitcoin and Ethereum, this design makes it appealing to banks and financial institutions who need speed and reliability. So to sum it up, Bitcoin is your digital gold, slow and steady for storing value. Ethereum is like a smartphone, powerful and flexible for running apps. XRP is the supersonic jet, built solely for lightning-fast, cheap payments. Each has its own role in the crypto world, and understanding these differences helps you see why XRP could revolutionize how money moves globally. Before we move on, if any of this sounds confusing, make sure to check our 24-minute course for complete crypto beginners, which will help you get a better picture of everything we are talking about. Link will be down in description. Now that we have compared these three giants, let us move on to topic number 6, the infamous SEC lawsuit against Ripple. We come to one of the most important chapters in Ripple's history, which is the legal battle with the U.S. Securities and Exchange Commission, better known as the SEC. This lawsuit wasn't just about Ripple. It became a defining moment for the entire cryptocurrency industry. Let me break it down for you in simple terms. In December 2020, the SEC filed a lawsuit against Ripple Labs, its CEO Brad Garlinghouse, and co-founder Chris Larsen. The SEC claimed that XRP was an unregistered security, meaning they believed Ripple was selling XRP like a stock or investment contract without following proper regulations. Now, why does this matter? Because if XRP had been classified as a security, it would have put Ripple under strict financial laws, making it nearly impossible for them to operate the way they do today. The lawsuit sent shockwaves through the crypto world. Major exchanges like Coinbase even delisted XRP to avoid legal trouble, causing its price to crash. But here's where it gets interesting. Ripple didn't back down. They fought back hard, arguing that XRP is a currency, not a security. They pointed out that XRP is used for payments and liquidity, not as an investment where people expect profits from Ripple's efforts. After nearly 3 years of legal battles, in July 2023, a federal judge delivered a partial victory for Ripple. The court ruled that XRP is not a security when sold to the general public on exchanges. However, the judge also said that XRP could be considered a security when sold directly to institutional investors. This ruling was huge. It gave clarity not just to Ripple, but to the entire crypto market. Many saw it as a win against the SEC's aggressive stance on crypto regulation. Almost immediately, exchanges relisted XRP, and its price surged. You remember I told you how Swift is fighting against XRP? Well, this is how. SEC shut down many promising companies, and Ripple is one of the very few that survived lawsuit against it. Many others didn't have enough resources to withstand the pressure they bring, making this even more significant victory for Ripple. But the fight isn't completely over. The SEC could still appeal, and the case might drag on. However, one thing is clear. Ripple's battle showed that the crypto industry won't just roll over when regulators come knocking. So what does this mean for you as an investor or someone interested in XRP? It means that while Ripple has survived this major hurdle, regulatory risks still exist. But with every legal victory, XRP's future becomes more secure. Now that we've covered the lawsuit, let's move on to something more practical. How can you actually buy and store XRP safely? That's coming up in topic number 7. Buying and storing XRP is simple if you follow the right steps. First, let us talk about where you can buy XRP. While many exchanges delisted XRP during the SEC lawsuit, all major platforms now support it. For beginners, the easiest way is to use centralized exchanges Binance or Coinbase, though availability depends on your country. The The reason for this is that major exchanges support traditional currency deposits, meaning you can deposit your funds in, let's say, US dollar value and easily exchange it for XRP in a matter of minutes. Once you have chosen an exchange, the process is straightforward. Create an account, complete identity verification if required, deposit funds using your bank account or credit card, then place an order to buy XRP at the current market price. The fees will vary depending on which exchange you use, but they are generally much lower than traditional banking fees we discussed earlier. After purchasing XRP, the most important step is storing it safely. Never leave your XRP on exchanges long term, because if the exchange gets hacked or goes bankrupt, you could lose everything. Instead, transfer your XRP to a secure wallet you control. There are several good options for XRP wallets, but wallets are topic for another video. We already covered 3 wallets for Bitcoin, Ethereum, and Solana network in our 24-minute course video. We will make a video on Bitcoin Academy in next few weeks, which will cover best wallet options for all top cryptocurrencies. So make sure to subscribe so you don't miss out on that guide. For this video, I will only suggest number 1 option I prefer, which is a wallet called Zaman Wallet, formerly known as Zoom. Once your wallet is ready, you can withdraw XRP from the exchange by entering your wallet address. Transactions typically complete in 3 to 5 seconds with fees less than a penny. For those holding large amounts of XRP, consider using a multi-signature wallet for extra security. This requires multiple approvals before any transactions can be made, protecting you from theft even more than normal wallets do. Now that you know how to buy and store XRP safely, let us look ahead to our final topic, the future of XRP and what it could mean for the global financial system. Before we continue, like button is right there, and your support helps us create more content like this. Now let us move to topic number 8, the future of XRP. Now that we have covered everything from how XRP works to how to buy and store it safely, let us look ahead to what the future might hold for this revolutionary cryptocurrency. The potential for XRP is enormous, but like any technology, its success depends on several key factors. First and foremost is adoption by financial institutions. We have already seen banks and payment providers testing Ripple's technology, with companies like Santander and SBI Remit using XRP for cross-border payments. If more banks follow suit, XRP could become the backbone of a new global financial system, replacing the outdated SWIFT network we discussed earlier. Another critical factor is regulation. While Ripple scored a partial victory against the SEC, the legal landscape remains uncertain. Governments around the world are still figuring out how to classify and regulate cryptocurrencies, and their decisions will have a major impact on XRP's future. However, the fact that Ripple has already established partnerships with central banks and financial regulators gives it a significant advantage over other cryptocurrencies. Technological advancements will also play a role. The XRP ledger is constantly being improved, with new features like smart contracts and tokenization being added to make it more versatile. These upgrades could open up new use cases for XRP beyond just payments, potentially competing with platforms like Ethereum in the decentralized finance space. Then there is the question of competition. While XRP is currently one of the fastest and cheapest options for cross-border payments, other cryptocurrencies and even traditional financial institutions are working on their own solutions. SWIFT is not going down without a fight, and new technologies like central bank digital currencies could disrupt the market further. So what does all this mean for you as an investor or someone interested in XRP? It means that while the potential rewards are high, so are the risks. XRP could revolutionize global finance and deliver massive returns to early adopters, or it could be overtaken by newer technologies and regulatory challenges. The key is to stay informed and make decisions based on facts rather than hype. We are almost done. Now you see with your own eyes and mind why it is important to understand all of this. We are just missing one more thing in our perfect crypto kingdom, which is villain, of course, and its name is Solana, or as I like to call it, Ethereum's crazy little brother, because you always have that one rebellious member of family. Is it good or bad? Well, I will let you decide after you hear all 6 topics regarding Solana. Moving to topic number 1, what Solana solves. Imagine you're at a busy coffee shop. There's only one barista working, and the line stretches out the door. Each customer takes 5 minutes to get their order: espressos, lattes, complicated frappes with extra whipped cream. You just want a simple black coffee, but you're stuck waiting behind 20 people. That's exactly the problem many blockchains like Ethereum face. They're slow, expensive, and can't handle too many orders, or in this case, transactions at once. This is where Solana comes in. Think of it as a coffee shop designed for speed. Instead of one barista, there are 50. Orders are processed in seconds, not minutes. The prices are lower because the shop runs so efficiently. And most importantly, it can handle a lunch rush without collapsing. That's the core problem Solana was built to solve, and it is called blockchain scalability. To understand why this matters, let's rewind a bit. Bitcoin was the first blockchain designed as digital cash. Ethereum came next, adding smart contracts, basically programmable money. But both have limitations. Bitcoin processes around 7 transactions per second. Ethereum does about 30. That might sound like enough until you realize Visa handles thousands per second. When too many people try to use Ethereum at once, the network gets clogged. Transactions slow down and fees skyrocket. Sending money suddenly costs $50 instead of 50 cents. Solana's founder, Anatoly Yakovenko, saw this problem and asked himself, what if a blockchain could be as fast and cheap as using a credit card? Traditional blockchains work like a group of people passing around a notebook, carefully checking every entry. Solana works more like a high-speed assembly line, where transactions are processed in parallel places. The secret sauce is something called proof of history, a way to timestamp transactions so the network doesn't waste time verifying the order of events. We'll dive deeper into how this works in the next topic, so don't let it scare you if you didn't quite understand it yet. For now, just know it's like giving every transaction a numbered ticket, so the system doesn't get bogged down arguing about who was first. The impact of this speed is huge. For developers, it means building apps that feel as smooth as the ones on your phone. For users, it means sending money for fractions of a penny instead of paying unnecessary high fees. And for Memecoins and NFT projects, it means launching tokens instantly without worrying about traffic jams. But speed isn't Solana's only advantage. It also solves another critical issue, which is energy use. Older blockchains like Bitcoin and Ethereum before its upgrade relied on proof of work, where miners burn massive amounts of electricity to secure the network. Solana uses proof of stake, where validators lock up their coins to participate, a system that uses less energy than a single Google data center. To put it simply, Solana is like upgrading from dial-up internet to fiber optic. It's not just a little better, it's a different league. And that's why it's become a hub for everything, from decentralized social media to NFT games. But as we'll see later, this speed comes with trade-offs. For now, just remember, Solana exists because the world needed a blockchain that could keep up with real-world demand, not just crypto enthusiasts. Moving on to topic number 2, which is how Solana works. Let me ask you something. When you send an email, do you worry about how the internet routes it across the world? Probably not. You just hit send and trust the system to handle the rest. That's exactly how Solana wants blockchain transactions to feel, instant and invisible. But to make that possible, it had to reinvent how blockchains track time itself. Here's the problem that Solana solves in one example. Imagine you're organizing a massive potluck dinner. Everyone brings a dish, but there's no clock in the kitchen. People keep arguing who brought their dish in first. Chaos ensues, and dinner gets delayed. That's how most blockchains work. They waste precious energy and time just agreeing on what happened when. Solana's breakthrough was creating a built-in clock for the entire network. This clock isn't just any timer. It's a cryptographic heartbeat that stamps every transaction with its exact place in history. We call this proof of history, and it's like giving every potluck dish a numbered ticket when it arrives. No more arguments. The system automatically knows your dish came in at 3:02 p.m. and the second dish came at 3:05 p.m. But how does this actually make Solana faster? Let's break it down in 3 segments. Number 1, the timekeeper. At Solana's core is a special algorithm that acts like an atomic clock. It creates a continuous, verifiable record of time passing. Every transaction gets stamped into this timeline the moment it enters the network. Number 2, parallel processing. With timing settled, Solana can process transactions like a busy restaurant kitchen. Instead of cooking one order at a time like Bitcoin does, it can grill steaks, boil pasta, and bake desserts simultaneously. This is called parallel execution, and it's why Solana can handle thousands of transactions at once. Number 3, the validator team. Hundreds of computers, which are validators, work together using this shared timeline. They're like kitchen staff, who all look at the same ticket system. When new orders come in, they don't waste time coordinating, they just check the timestamp and get to work. Here's what this means in real terms. Transactions finalize in about 2 seconds, compared to Ethereum's 15 seconds to 5 minutes. Fees stay around a fraction of a penny even during busy times. The network can scale as more users join without slowing down. The magic isn't just in the speed, though. Proof of history enables something even more important: decentralized trust. Because the timeline is mathematically verified, you don't need to trust any single validator. The network itself proves what happened when, removing human factor risk. If any of this still sounds confusing, don't worry. It will all make sense by the end of this video. All right, let's move on to topic number 3, smart contracts and decentralized applications. Imagine walking into a futuristic shopping mall where every store runs entirely by machines, no cashiers, no managers, just perfectly programmed robots that never make mistakes. You buy shoes from one robot store, and it automatically pays the manufacturer, the shipping company, and even gives a royalty to the shoe designer, all within seconds. This isn't science fiction. This is exactly what smart contracts are and how they work on Solana, creating an entire economy where code replaces middlemen and everything happens at lightning speed. These digital robots, that we call smart contracts, are essentially self-operating programs that live on Solana's blockchain, executing agreements automatically when certain conditions are met. Think of them like vending machines for complex transactions. You put in your money, select what you want, and the machine handles everything else without needing a human operator. The magic of Solana is that these smart contracts can process thousands of transactions simultaneously for less than a penny each, making possible applications that would be too slow or expensive on other blockchains. Right now on Solana, there are thousands of these decentralized applications running everything from NFT marketplaces that do millions in daily sales to lending platforms where you can borrow money without a bank, all operating with the efficiency of an Amazon warehouse, but without any central company controlling it. A great example is the STEPN app, which paid you cryptocurrency just for walking or running. It used smart contracts to automatically track your activity and send rewards to your wallet, with no company in the middle taking a cut. And yes, you are not crazy. That did happen. That is why I am telling you that it is super important to stay in touch with development of cryptocurrencies, because yes, if you were there back then, you could have earned money for basically walking. So if you still didn't, make sure to subscribe. Another example is Magic Eden, an NFT marketplace where artists can sell digital artwork directly to collectors, with smart contracts ensuring they get paid instantly and even receive automatic royalties every time their art gets resold. What makes Solana special is how these different applications can work together seamlessly, like digital Lego blocks, allowing developers to create complex financial services, games, and social networks that feel as fast and easy to use as the apps on your phone. While Ethereum might process these smart contract interactions one at a time, like cars waiting at a toll booth, Solana handles them like a high-speed train system, with multiple tracks running in parallel. This speed and low cost has led to an explosion of innovation, with new applications popping up daily that are redefining everything from how we see banks to how we play games online. However, as we'll explore in later topics, this incredible speed does come with some trade-offs in terms of network stability and decentralization. But for now, just understand that Solana's smart contract capabilities have created a playground where developers can build applications, limited only by their imagination, all running on a global network that never sleeps and doesn't ask for permission from any government or corporation. We have come to my favorite topic regarding Solana, which is Memecoins and community. Try to picture this. It's midnight, and instead of sleeping, thousands of people are gathered in a digital town square, trading cartoon dog pictures that somehow turned into million-dollar assets. You don't need to imagine anymore. Welcome to Solana's Memecoin ecosystem, where internet culture meets serious finance, and where a single joke can spark an economic revolution overnight. This isn't just speculation gone wild. It's proof of what happens when you combine lightning-fast transactions with a community that treats crypto like an investment and an extreme sport. The secret sauce isn't just the technology. It's how Solana's speed and low fees created the perfect playground for viral tokens. Where Ethereum might charge you $50 just to buy a meme coin, maybe more than the coin itself might be worth, Solana lets you trade them for fractions of a penny. It's like needing a Wall Street broker to trade stocks versus having a vending machine that spits out whatever internet trend is this minute. This accessibility birthed icons like Bonkcoin, for example, a dog-themed token that went from being literally given away for free to being listed on major exchanges, making early investors millions overnight, all because the community willed it into existence. But meme coins are just the flashy surface. Dig deeper, and you'll find Solana's true superpower, a developer community building at breakneck speed. While other blockchains debate upgrades for years, Solana builders operate like a Silicon Valley startup on energy drinks, shipping new projects weekly, from decentralized social networks to AI-powered trading bots. The energy is contagious, turning users into evangelists who'll defend Solana through network outages and bear markets. This loyalty isn't blind faith. It's because many community members have literally built their livelihoods here, whether through trading, creating NFTs, or developing the next big DApp. It is a whole world out here. Yet for all its strengths, this culture comes with warnings. The same speed that enables innovation also enables scams to proliferate faster than moderators can stop them. The community's move-fast mentality sometimes clashes with the need for stability and security. And as we'll explore next, these tensions reveal Solana's growing pains as it transitions from rebel upstart to mature blockchain. But love it or hate it, one thing's undeniable. No other chain has captured crypto's chaotic, creative spirit quite like Solana. Moving to topic number 5, Solana's biggest challenges. Imagine you bought the fastest sports car ever made. It goes 0 to 100 in 1 second, costs pennies to fuel, and everyone turns heads when they see it. But sometimes, when you push it too hard, the engine overheats. That's Solana in a nutshell. Revolutionary speed with real reliability problems. Let's peel back the hype and examine the 3 biggest challenges threatening Solana's future. First, the network outages. Solana has suffered more than a dozen major crashes, some lasting over 18 hours. Picture our sports car stalling on the highway during rush hour. These outages usually happen when too many users flood the network at once, like when a hot NFT drop or meme coin frenzy overwhelms the system. While developers keep tweaking the engine, these blackouts spook big investors who need rock-solid stability. Second, centralization concerns. Remember those validators securing the network? Here's the dirty secret. You need expensive, high-end computers to run one, and over 35% of them sit in data centers owned by just 2 companies. It's like having a decentralized town where half the voting booths are controlled by the same family. This happens because Solana's speed demands cutting-edge hardware, pricing out regular users. Compare this to Ethereum, where you can run a validator on a basic laptop. Third, the competition is catching up. Chains like Sui and Aptos now offer similar speeds without Solana's downtime. Even Ethereum is getting faster with its Layer 2 solutions. It's like being the only fast food joint in town, only to see McDonald's, Burger King, and Wendy's all open locations next door with cheaper menus. The stakes couldn't be higher. Institutional investors won't fully embrace Solana until it proves it can handle Visa-level traffic without hiccups. Mainstream adoption requires trust that the network won't freeze when you need it most. And developers may jump ship if competitors offer better stability. Yet there's hope. The team's aggressive upgrade schedule shows they're taking these issues head-on. The upcoming upgrades promise to double speeds while preventing crashes. And the community's build first, fix later ethos means solutions emerge faster here than on slower chains. Congratulations on making it to topic number 6, which is the future of Solana. Picture this. It's 2026, and you're buying coffee with Solana Pay app. The transaction settles before the barista finishes pouring. Your friend messages you on a Solana-based social app, bragging about earning crypto for his viral post. Meanwhile, in the background, smart contract automatically splits your paycheck between savings, investments, and that concert ticket you've been eyeing. This isn't fantasy, it's the future Solana's builders are racing to create. But will they get there? Let's examine the 3 make-or-break factors that will determine whether Solana becomes the internet's financial backbone or just a cautionary tale about moving too fast. First, the upgrades. Solana's roadmap reads like a rocket engineer's checklist. The upcoming upgrades aim to double transaction speeds while eliminating crashes. Think of it like adding a second engine to our sports car that kicks in when the first one overheats. Then there's token extensions, giving businesses customizable crypto tools as easy to use as Stripe's payment system. Most crucially, they're tackling decentralization with local fee markets, which could finally let regular users run validators on consumer laptops instead of expensive server farms. Second, adoption is exploding in unexpected places. Visa now settles USDC stablecoin payments on Solana. Shopify stores are testing Solana Pay for instant checkouts. Even the New York Stock Exchange is exploring tokenized assets on the network. It's reminiscent of how the internet grew, first dismissed as a toy, then quietly becoming essential infrastructure. The key metric to watch are daily active users. When grandma starts using a Solana app without realizing it's crypto, that's when you'll know they've won. Third, the community's evolution. The Memecoin degenerates, who built Solana's early culture, are now sharing space with Fortune 500 companies. This tension between rebel energy and institutional needs will define Solana's identity. Will it become the blockchain equivalent of Apple, beloved by creatives and corporations alike, or fracture into niche communities as Ethereum did? The developers aren't waiting to find out. Over 75,000 now build on Solana monthly, 3 times Ethereum's early growth rate. The wildcard is regulation. As governments worldwide crack down on crypto, Solana's US roots make it both more compliant than offshore chains and more exposed to legal challenges. The coming year will test whether its team can navigate these waters without sacrificing the decentralization that makes blockchain valuable in the first place. One thing's certain, Solana won't evolve in a vacuum. But if Solana can fix its stability issues without losing its speed advantage, it could become the first blockchain to truly go mainstream, not as a speculative asset, but as invisible plumbing powering the next generation of the internet. We have reached the end of this video, and I guarantee you that now you know more about crypto than 99% of all people. Now, after understanding basics, if you want to learn about investing and trading strategies, make sure to check one of these 2 videos that you see on the screen right now. Leave a comment, subscribe, and see you in some of our next videos.